fundamental accounting equation. States that all assets equals liabilities plus owner's equity. It is used in double entry accounting and shown in the balance sheet, in which all assets can be added up as the equivalent of the liabilities and shareholders' equality. Accounting cycle describes the steps taken in the accounting process, a 6-step procedure that results in the preparation and analysis of the major financial statements. Journals. Important in the accounting cycle. When a transaction occurs, it is initially put into the cycle based on when transaction occurs. Ledgers. After journal cycle, the information is transferred into this cycle. It contains different accounts like asset accounts, revenue accounts, expense accounts, liability accounts, and equity accounts. Double entry bookkeeping. Bookkeepers record all transactions in 2 places so they can check one list of transactions against the other for accuracy. 2 columns are used. All of the debits are placed on the left while the credits go on the right. Credits. Decrease assets and increase liabilities. Debts. Money that is owed to someone else. Debits. Increase assets and decrease liabilities. Trial balances. Income statements. Accounting statements, also called profit and loss statements, that show what has happened to an organization's income, expenses, and net profit over a period of time. Balance sheets. A financial statement that sums up a firm's financial position on a particular day, usually the end of a quarter or year. It is a snapshot showing the financial situation of the company. Statements of retained earnings. A very important financial document required when income statements and comparative balance sheets are given. It showcases how a business retained earnings change over a period of time. Statements of cash flow. Explains how the company's cash changed from the beginning of the accounting period to the end. It is a major accounting document that outlines the inflow and outflow of cash from a company. Financial ratios. Calculations typically used to track a business's liquidity, efficiency, and profitability over time compared to other businesses in its industry. Payroll records. Documentation used to process earnings, payments, and record each employee's pay history. Payroll records contain information on all employees of the company, their compensation, and benefits. Payroll accounting procedures. Periodic inventory system. An inventory system in which a company does not maintain detailed records of goods on hand throughout the period and determines the cost of goods sold only at the end of an accounting period. Perpetual inventory system. A detailed inventory system in which a company maintains the cost of each inventory item and the records continuously show the inventory that should be on hand. Inventory costing systems. LIFO Method. An inventory costing method that assumes that the earliest goods purchased are the first to be sold. LIFO Method. An inventory costing method that assumes that the latest units purchased are the first to be sold. Average cost. The total cost divided by the number of units. The total cost output. Specific identification method. Identifies the cost of the specific item that was sold. Depreciation. A decrease or loss in value. It is the concept that assets such as equipment, machinery, and cars have a useful life and will only be usable for a certain amount of time and therefore lose value as time goes on. Management accounting refers to the evaluation of information for the purpose of managers. It can include the identification, measurement, evaluation, interpretation, and communication of information. Focuses on reporting information to management. Cost accounting is useful for managers to help make decisions while planning and controlling, used to reduce and eliminate costs in a business. Cost accounting is used to determine a price for a product or service that will allow earnings of a reasonable profit. Types of cost: variable cost, fixed cost, direct cost, indirect cost. Direct cost: the costs that go directly into making a product, a cost which can be clearly identified with a particular unit of output. If a company is manufacturing pens, then the cost of the ink would represent this cost. Indirect cost: fixed cost, a cost that does not change no matter how much of a good is produced. Variable cost: a cost that rises or falls depending on how much is produced. Costs that change as output changes. Cost volume profit analysis: part of managerial economics and looks at how alterations in the cost and sales volume change the profit of a company. Return on investment: the amount earned from an expenditure. Investment options: real estate, bonds, stocks, mutual funds, or savings account. Bonds, stocks, mutual funds. Businesses that take money from a variety of investors and put it in a portfolio of bonds, stocks, securities, and assets. A person who buys into this fund will hold a portion of ownership of the portfolio and reap the rewards when the portfolio gains value. Personal income taxes: taxes paid by households or individuals in households on all forms of income, including wages, rental income, interest income, and dividends, is the most important source of government tax revenues in many countries. Taxes on the money a person earns. Federal Insurance Contributions Act: a federal system of old age, survivors, disability, and healthcare insurance which requires employers to withhold wages from employees' paychecks and deposit that money in designated accounts. Medicare taxes: taxes paid by employees and employers to the federal government based on the amount of money paid to the employee by the employer each pay period. These taxes pay for healthcare benefits for retired and disabled workers. Property taxes: taxes paid by anyone who owns properties such as land, a home, or commercial real estate. Gain taxes: based on profit from a non-inventory asset such as bonds, stocks, property, and precious metals. Sales taxes: paid on items people buy, added to the price of goods and services at the time of purchase. Credit cards: allows people to make purchases in advance and then pay it back monthly. People can keep a balance on the cards, but the interest can be very high. Auto loans: a personal loan to purchase an automobile, allows people to pay off their car slowly, but they can lose the car if unable to pay. Mortgages: loans made to let people purchase home. Generally, these loans come from the bank and allow home buyers to slowly pay off the house with interest. Foreclosure: process by which the holder of a mortgage sells the property of a homeowner who has not made interest and or principal payments on time as stipulated in the mortgage contract. Home equity loans: homeowners can borrow against the appraised value of their already purchased homes. The person's equity is put up as collateral in case the person defaults on the loan. Variable loan: a loan in which the interest rate changes along with the market interest rate, changing the payments. Bankruptcy: a legal process to get out of debt when you can no longer make all your required payments, has a major impact on personal credit. Chapter 7: Bankruptcy. Chapter 11: Bankruptcy. a form of bankruptcy that involves the reorganization of a business's debts, affairs, and assets. A reorganization form of bankruptcy for businesses that allows them to continue operating under court supervision as they repay their restructured debts. Chapter 13 Bankruptcy. Equivalent to Chapter 11 Bankruptcy but applies to natural persons. This type of bankruptcy allows for a payment of debt over a period of time and debtor keeps assets. A repayment plan for debt for individuals. Annual percentage rate. Cost of borrowing money on an annual basis takes into account the interest rate and other related fees on a loan. Life insurance. A type of coverage people buy that pays out upon a person's death. Beneficiary. One who benefits from something, a person who is left money or other property in a will or the like. Rider. Changes provisions or clauses of the insurance policy. Annuities. A fixed sum of money paid to someone each year, typically for the rest of their life. Actuarial tables. A comprehensive list of statistical data used most often by insurance companies to determine illness, disease, and accident projections shows the chance someone will pass away before their birthday, used by life insurance companies when developing plans and pricing. Automobile insurance. Covers drivers in the case of an occurrence that causes some sort of damage or harm. Liability coverage. Protection against injuries suffered by others on your property or as a result of your actions. Collision coverage. Cars involved in an accident, people often have a deductible or money have to be paid first. Premiums. The amount a driver pays monthly or regularly to maintain coverage. Comprehensive insurance. Covers cars damaged without a collision such as from vandalism or weather-related events. Property insurance. Provides coverage against a wide variety of risks and includes fire insurance, earthquakes insurance, home insurance, and flood insurance. Open perils. Where all losses are covered except those losses specifically excluded. Replacement insurance. Insurance that actually replaces an item that has been destroyed. Health insurance. Insurance that covers medical illness or injury. Employer-sponsored plan. Employer-provided group coverage. Employees must meet service requirements and work full-time. Medicare. A federal program of health insurance for persons 65 years of age and older. Medicaid. A federal and state assistance program that pays for healthcare services for people who cannot afford them. Preferred provider plan. Generally gives greater benefits if an individual sees someone in-network as compared to out-of-network. HMO. Health Management Organization contracts physicians, hospitals, and other providers and gives benefits based on that. Strategies for lowering products cost. Take advantage of sales, look for coupons traditionally and online purchases, purchase items on clearance, purchase in bulk, and compare shops to look for the lowest price on an item. Factors that can influence employment opportunities. Economic factors, geographic location, education, skills, and experience. Factors that can influence cost of living. Housing prices, family size, inflation. Factors that influence personal income. Person's education, experience, job market, geographic location. Profit margins. Sales price. Commission. an amount paid to an employee based on a percentage of the employee's sales. For instances, if an employee receives a 10% commission on $100, then he will receive $10 in commission. The employee will need to calculate taxes on the commission to ascertain the final pay. Hourly wages. Percentages. Frequency distribution. An arrangement of data that indicates how often a particular score or observation occurs. Mean. The arithmetic average of a distribution obtained by adding the scores and then dividing by the number of scores. Example, 3, 2, 3, 4. Add them to get 12 and then divide by 4 to get 3. Mode. The number that appears the most. Example, 3, 2, 3, and 4. That number will be 3. Median. The number that would appear in the middle if the numbers were put in order. X, 7, 3, 9, 1, 5. In order it will be 1, 3, 5, 7, 9. That number will be 5 because it is in the middle. Line graph. A graph that uses line segments to show changes that occur over time. Scatter plot. A graph with points plotted to show a possible relationship between two sets of data shows how two variables are related to each other. Bar graphs can be used to show data in a way that it is clear and easy to understand, used to compare amounts. Circle graphs. Useful visual aid that shows a variety of data. Show fixed quantity, also called a pie graph. Circle represents the total and slices represent the different parts as percentages. Asset. Something that produces value and is owned. Fixed asset. A tangible asset that is generally used to generate profit and will not be turned into cash within the year. Variable asset. May be transformed to cash sooner and will include the inventory of the actual product. It can also include accounts receivable, the money customers own for delivered items. Accounts receivable. Amounts to be received in the future due to the sale of goods or services is the money that a company has a right to receive because it had provided customers with goods and or services. Accounts payable. Amounts to be paid in the future for goods or services already acquired includes all the money you owe to vendors. Keep track of credit that vendors have extended to you. Intangible asset. Not tangible. It's not physical. It includes recognition of the brand name as well as intellectual property like logs, trademarks, and patents. Liquidity. The ease with which an asset can be converted into cash refers to how easily an asset can be bought or sold on the market at the same price. It also refers to being able to make an asset become cash easily and quickly. Equity. Shows what the owner has contributed in addition to the retained earnings, ownership, debts, the sum of your asset. Depreciation. Refers to how things lose value as time goes on. Cash flow. Refers to the actual cash that is going in and out of a business, such as revenues or expense due to business activities. Expense. The cost of goods or services used to operate a business. GAAP. Provides a set of standards of how accounting figures and statements such as income statements, balance sheets, and cash flow statements are prepared. It is a set of rules that direct how these forms are prepared so that investors understand what they are getting when they receive the statements. U.S. Security and Exchange Commission. A U.S. government agency that oversees securities transactions, activities of financial professionals and mutual fund trading to prevent fraud and intentional deception. Financial Accounting Standards Board is a private, non-profit organization standard-setting body whose primary purpose is to establish and improve generally accepted accounting principles within the United States in the public's interest. cash accounting. The transactions are counted when the money is actually received or the expenses are paid out, regardless of when an item was ordered or delivered. Accrual accounting method. The transactions are counted when the orders are made or delivered, even if no cash has actually exchanged hands.